We call stocks securities. It's kind of a funny name for an investment that sometimes makes us feel pretty darn insecure. So, two questions in this, or two parts to this one question. Can you tell the audience how you determine if a stock is a good value? And when you're looking at the equity markets today, compared to the historical valuations, how do you think they look? Are they fairly priced, or are they potentially inflated? What's your opinion these days?
Sure. In terms of looking at a security, how we value it, we view the value, we're looking at the value of a company, and the value of a company is the value of the future stream of cash flows that company is going to generate, discounted back at a proper discount rate that reflects the risk of those cash flows, the risk that the company is taking in putting together those cash flows. So what we do is we model out a company, model out all the factors, apply our terminal multiple, et cetera. But I think the important concept in terms of valuing companies is we're not looking at it as trading pieces of paper. We're estimating an intrinsic value for each security, and then we're comparing the market price, and we're trying to buy that at a margin of safety. The estimate of that value is based on the particular characteristics of the company, the barriers to entry, the growth opportunities, what's going on in their industry. In terms of looking at the current market levels, it's kind of interesting. Obviously, there's been quite a change in a year or so. Last year, to just make it brief, last year, first quarter of last year, investors were building into stock prices. They were discounting that the environment was going to be bad, the economic environment was going to be bad, and it was going to stay bad for a very long time. And now what we have is, to some extent, the opposite, perhaps not quite as extreme, that we've got very much improved environment, and investors are discounting that the environment is going to stay good for a long time. But just to get a little more specific about that, is the market as a whole at a reasonable valuation? If you look at projected earnings for 2010 or 2011, then the S&P 500, representing the broad market, looks to be fairly reasonably valued based on historical PE levels, maybe in the mid-teens, depending on what numbers you use, maybe even a little bit below the mid-teens levels. If you look at what's called a Graham and Dodd PE, Warren Buffett's mentor, Ben Graham, and his security analysis partner, David Dodd, they looked at 10 years of average earnings. And the reason they looked at 10 years is to take out the cyclicality of that. You may have one good year, and if you just value a company based on that one good year, then you may mislead yourself into saying that the valuation looks reasonable, but it's not sustainable. So if you look at the price of stocks relative to 10 years average earnings, then we're in the top quintile of valuation based on historical levels. And from these types of valuations, the forward 5 to 10 year returns have typically been more in the, say, low single digits, maybe as high as mid single digits, which are not particularly attractive returns if you're investing in stocks, which are more risky than bonds and other investments. So what does this mean to us? Well, the way I view this is if you believe these high profit numbers that we're generating in 2010 and 2011 in the stock market, they're only achieved through profit margins that are at all-time high levels. The net margin for stocks is now back up. The trailing 12-month margin going into the end of the year was around 6.5%. If you throw first quarter on there, we'll probably be above 7% for a trailing 12-month net profit margin on S&P 500 companies. That is it's near or at an all-time high level going back into 50, 60 years. So if you believe that this all-time high level of profit margins in the U.S. Public companies can be maintained for an indefinite period, then stocks are valued at fairly reasonable levels versus historical. If you believe instead that these all-time high profit margins will likely revert to the mean to some extent, as things often do in the investment world, then valuations are pretty high. At my firm, Diamond Hill, we tend to be skeptical of saying that we've reached a new plateau of profit margins. They're going to be higher than ever before, and they're going to stay there at that level for a long time. We really don't make broad market calls, but when we look at individual securities, we find it difficult to find a lot of securities at attractive margins of safety. So we've let our cash positions increase. We're looking for high-quality investments, and in general, our view is more that these high profit margins will likely not be sustainable indefinitely.